Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton, the Director of Investor Education here at PassiveInvesting.com. And I am so excited to have with us today a return guest, Chris Stout. Chris, welcome back to the show.
Hey, how's it going? Thanks for having me again.
Absolutely. Well, today we're going to be talking about Willow Park Apartments, 56 units in Fayetteville, Arkansas. But before we dive into those details, let's just recap your background and where you're at in the multifamily space today. And you know what?
Yeah.
If for those people who are not joining live and can't see you on video, also tell them where you're recording from too.
Yeah, sure. So we'll start with that. So I'm recording from my new home in Oceanport, New Jersey. So we're building a house on the water. And I don't know if you all are able to, if you're all watching the video side of it, let's see if we could get, so we have a pretty spectacular view from the house.
That's amazing.
We have our boat back in the yard. So just to keep it fluid, you guys could see exactly where I am. But yeah, so Oceanport, New Jersey, it's basically it's directly below New York City on the coast of New Jersey. So we basically have Jersey Shore living, but still close to the city. So access to civilization is very, very close. Where if you get further south than here, then it starts to become a little bit more vacation-y and people have second homes and retirement and all that. So we wanted to, it was either buy a bigger boat or buy a house on the water. So we decided to buy a knockdown, buy the worst house in the block, knock it down and put a new house here, which wasn't my full intention. I actually did lie to myself a little bit, saying that I could fix the old house and put a new one on top of it, but it didn't go like that. So then we put this monstrosity here. I don't really know why we put such a big house, but I think after we framed it, I stood back and looked at it and was like, man, I think we might have went too big, but whatever.
Well, I'm sure your what you do in the multifamily space is helping you with this vision of this new house. So tell us about your background and what exactly you do in the multifamily space.
Yeah, so my background is actually home building. So I started with a renovation company in my early 20s. And while I was developing a renovation company, I was buying two-family homes in New York. So I grew up in Staten Island, New York. So two-family houses there are very common as far as like an investment. People want to buy two families and you're just accumulating those as time went on. So I would do renovations for people. And then I started building custom houses for people, and all the money I made would go back into the two-family business. So just picking up, my goal at one time was 1 a year, then it was 2 a year, then it was going 3 a year, and then we would just, once we started to be able to leverage each property against itself, and when we sold one, turned it into 3 or refied one, once that started, then the accumulation started to pick up quicker. And all at the same time, I'm building the building business. And then I built it into a spec home building business. So we were building houses to sell. And as probably everyone listening knows, is that's very capital intensive. Development's fairly capital intensive. You need money, which goes out at a little bit more of a risk rate than a multifamily would, right? So we say stabilized multifamily being the least risky, then value add being a little bit more risky, and then development being riskier than those two. So I was actually leveraging the relationships that I built with everything I was doing into turning those people into investors in my spec home building business, all while accumulating apartments on my own. So a certain amount of time went by, and one of my investors in the development side said, "Hey, this is good and all, but the money comes back too quick. So when it comes back, and then you don't have a place immediately to put it." So basically what was happening was it wasn't raising capital and putting people's money to work wasn't really the business. It was, we're building houses and we need money. So now we'll bring people in. So, I would use capital. And then when we were finished with a project, we didn't have something immediately lined up, but we were still working. So in development, a lot of times you own a piece of land, you're working on approvals. When the approvals hit is when you actually need the bulk of the money. So we were we were going through these cycles, and one of my investors says, "Hey, this is great, but the money comes back too quick and you don't have a place to put it. What else? Could I come in your apartments?" And I'm like, "No, the apartments are for me. I want to keep those for my family." Then I learned about the syndication business and realized that I could start raising capital and putting it into the apartments, which I've been doing for 10 years at this point. So I didn't wake up one day and decide that, I was a landscaper, and then I wanted to start operating apartments with capital of other people. I've been doing it by myself for a long time. And I was one of the ones that started from the bottom. So, I bought my first 2-family. I ran it by myself, and I spoke directly to the tenants. I was the one collecting the rent, taking the phone calls, all that. Then ran it up that I have now a staff in-house managing my stuff locally. But when I decided to start taking investors on, I realized that I shouldn't be investing in New York. I almost considered it irresponsible to invest in New York with investor capital, because we can't control the asset as well as we'd like to here. I'm in New Jersey now, which is like one step behind New York. Not as bad as New York, but close. Where if someone decides to stop paying, like, we got no recourse. Like, all right, we'll see in court, I guess, and 8-9 months, we'll get you out maybe. And New York, the way it's set up is you could actually be locked into a tenant forever. So if you rent to someone and if you pull a non-payment case, so in New York, there's typically, not to get into the evictions, but in New York, there's 2 major kinds of evictions, non-pay and holdover. If you take a non-pay case against somebody in New York, and anytime during the eviction process, all the way up to the last moment, if they find a program within New York that is able to catch them up, which is a lot, you'll get paid in full for that rent, and now that case is dismissed. So now you're stuck with someone who you now have to, if they decide to stop paying again, which it's typical that when people stop paying, they don't start again, you would have to restart a case, and that cycle could just keep going on and on and on until they can't find any more programs. But it's years. So yeah, that's my story as why I left New York investing. And now we raise capital, and we took the show on the road, and now we work in states that want to have us there and are respectful of the business.
I like how you phrase that, right? Because it's I think sometimes investors get a bad rap, as landlords, saying that, oh, you just want to be in a state where you can push somebody out. And I think it's more about like where, the state respects the business, and now it's up to the landlord to run a good operating business that respects the tenant too. So, and it gives you a little bit more leeway on how you work with the tenant.
I thought of this recently. I don't even like the term landlord-friendly state. I think that term is unfair. It's not landlord-friendly or tenant-friendly. It's simply what's right. In any business across the board, if I have a service, because in apartments, the apartment is our product and the tenants are our customers. So in any business, if you have a product and someone takes that from you, steals it without paying for it, that's against the law. That's just it's not even you don't even need a rule to be written about that. It's just natural that is wrong. So it's not so much landlord friendly and tenant friendly. It's we're offering a service, and if you don't pay for it, you can't have it. It's that simple. And it's not favoring one side or the other. Both sides have to do their job. One guy has to pay, and one guy has to supply. And once the payment and supply happens, well, now we have a complete circuit. So the idea that the idea that we label it landlord-friendly state, I'm not even in favor of that. I think it's just states that allow us to do business. It's that simple. And the states that are landlord-friendly, or we call landlord-friendly, allow us to do business. When someone doesn't pay, it's not like, day 5 they're out. There's still a month or 2 lag between the time that they stop paying and the time that they actually have to leave the apartment. That 2-month buffer, that's plenty of time to figure out where you're going to go next. Like, what are we going to do? Are we going to move back in with mom? We're going to go to a less expensive market or a less expensive apartment. So even with that,
Or
2 months,
cure.
I think is, what's that?
Or cure the deficiency, right?
Yeah. Or just pay. How about that? So, I think sometimes people live above their means. Sometimes people are. I had one tenant, and we shouldn't go down this road, but I had a tenant, and it's just a story. I know people like stories. I had a tenant that one of my local properties, he lost his job. Okay. So I called him. I'm like, hey man, what's going on? So you lost your job. And this was a year ago. So a year ago, and probably still currently, I mean, you go to any restaurant anywhere, you could get a waiter job. I mean, restaurants are just short on employees everywhere, or every major market, I should say. And we're in New York City. So how many restaurants are here? I think they said it'd be impossible to eat at every restaurant through the course of your life in New York City. If you picked one restaurant, you ate there once a day, you couldn't cycle through the city in a lifetime. So, okay, so I was on the phone with him. I'm like, hey, so you lost your job? He's like, yeah. He's like, I'm going to need a little help from you. I'm like, okay, you moved in a month ago, so we don't really have a relationship, but I could get you a waiter job starting this weekend. And that will bridge your gap so you could go become a waiter, make enough money to pay your rent, definitely. And then, find what you want to do. And when that happens, you could leave the waiter job, but I'll have a job ready for you. He's like, nah, I really don't want to be a waiter. I'm like, no, I get that. And neither do I. But if it came to it and I had to support my family, I would become a waiter. We're not asking you to clean toilets in Yankee Stadium, which, listen, that's a job too. But become a waiter. It's a respectful job. You work a couple days a week and you make enough money. Nah, I'm not really interested in becoming a waiter. So that's where the problem lies with tenants. Is like, no, I'm just going to decide that I'm not going to pay rent. So, all right, let's get into investing.
I think this is a subject, we don't get into like the theoretical so much on this podcast. We're, usually just very, very focused on the asset, but, thank you for kind of diving down that rabbit hole of the difference between, doing business in different states and, how that impacts the owner of the property and then also the tenant of the property.
Yeah.
But let's dive into.
When you become a property owner, the part that no one really talks about is your business. That the whole business is leasing space to tenants. That's and that relationship. It's the whole business. So sure, we pay our LPs distributions as time goes on, and all that splits. So everyone likes to talk about splits, preferred returns, hurdles, how we raise the money, all that. But without the tenant and property owner relationship and that money coming in, this business is zero. Nothing happens. So that if that relationship is not focused on and people go into and take that relationship for granted, they will be one of the people who are in trouble with their multifamily property because they didn't realize that the whole business is the tenant property owner relationship. If all tenants went away or all tenants decided to get paid, you could throw hurdles and preferred returns and everything. Throw it all out the window. It doesn't matter. So
very true. Very true. Well, let's dive into the details of Willow Park Apartments, 56 units in Fayetteville, Arkansas. Let's tell the listeners, when did you close and how much did you pay for the property?
So we paid $4.9 million, 56 units, and we closed in June. We closed this last June.
Awesome. So how did you find the property? Was it on market, off market?
So this deal, and so we find markets, and in the past we've been broker heavy, right? We found most of our properties through brokerage or brokers. This property specifically we found through a broker, but it was a little bit different. It was the idea that we are relentlessly calling everybody consistently. So we are constantly following up with property owners, constantly following up with brokers, not waiting for stuff to just hit the market. And actually within the last 12 months, not only have we not purchased anything from a marketed property, when something's marketed, we automatically pass in the last 12 months. We don't even want to look at it. And the reason is, and this is my opinion, that the brokerages, CBRE, Marcus and Millichap, they're so little on the market, and these guys' marketing tools are so powerful. Their marketing engine is set up to be handling a much higher deal flow, that when there's a deal that's been live over the last 12 months, there's someone out there who's willing to pay significantly more than we are. So how have we been focusing getting deals, and how do we get this deal? How we got this deal was through a broker, but it was calling a broker at the right moment that he just got off the phone with a guy who wants to sell his property and said, hey, I think he'd be interested at 4.9. We looked at it. We're like, all right, submit it at 4.9. We'll buy it. We'll take it. And we said, we're going to take it. We're going to take it with hard money. And it just moved so quick. Get the PSA out, boom, went out, signed, came right back, and we were in contract.
So is there any competition here, or like you literally were the only people putting in an offer on this building?
There was another competitor on it that called me about a month ago, and he saw me on Instagram, and then saw me on Instagram, tracked my phone number down, and called my cell phone. He's like, hey, man, I just want to let you know that I'm a follower of yours on Instagram, and I was bidding against that property while you were bidding on it without knowing that you were the guy. He's like, it just blows my mind how I know who you are. I watch your stuff. I engage with your content, and little that I know is I was competing against you on a deal. And, you know, because we don't really announce the deal until it's official, right? So it's until we have a signed contract. But the guy tracked me down, called me, and let me know. And he's like, he said he was actually 50,000 higher than us, but we gave the hard money, and the hard money won the deal.
How much hard money did you put down?
It was 50,000.
And what were the other terms of the contract? Let's also dive in there.
Yeah, so we're closing a deal at the end of this week, so I have a little bit of deal merge in my head. But the terms of the contract were 15 days due diligence, 50,000 hard. At the end of 50,000 hard, at the end of due diligence went another 50,000 hard. So by 15 days, we had 100,000 hard, and we closed within 60, but we beat that closing time. So we put in the contract 15 and 60. We wound up closing in like 15 and 30. So we wound up closing the deal in 45 days after signing the contract.
Okay. And did you guys have to retrade it all through the process?
No, we didn't have to retrade. The deal penciled out extremely well. And, you know, right now more than ever, we go deep on underwriting. We have all our spreadsheets, and we go through everything, you know, like sponsors usually do, but we're very big on the 1% rule with the 90s product. So if a product is built in the 90s or 2000s, 1%, the rent versus what we're paying a door, it works very well for us. And if we hit that, we think it's a good investment. And on this deal, what do we pay a door? We paid 56. We paid 87.5 a door, and the apartments are leasing for 1,100. We're getting renewals at 1050.
Awesome. Well, let's back it up a little bit. Okay, so you closed in June. When did you tour the property? Like, did you tour it before you put in the offer, or did you tour it after you put in the offer?
I'll tell you. So, I'm just going to interrupt you can you hear that drilling in the background?
Yeah, but it's part and parcel with building a house, isn't it?
All right. As long as you can hear my voice over it and it's not interrupting. I could go outside, but so this is my typical process. I don't tour deals before submitting an LOI. So I know that, let me go outside. So I know that most people like to tour properties, and they tour properties, and they almost talk badly about people who don't tour properties before submitting an LOI. But I can tell you through being in construction that I've been through so many structures in my career that I could tell from photos what condition that property's in. So I do not have to be on site to tell you what the CapEx level is going to be. And I don't have to be on site to tell you what kind of shape it's in and how you've taken care of it over the period of time that you owned it. So it's funny. I mean, all the years of being in construction, I didn't do that to gain that knowledge, that specific knowledge of being able to do that. But I am able to leverage it now because I've been in so many things and I've seen so many things come apart and go back together that even from Google Maps, I could look at something and be like, that thing's a disaster. We're not even interested in going there. So really, once we start seeing that we get good traction with a number and we're able to really put pen to paper with the seller, then we shoot out and we'll go look at it to confirm what we see. And it's really never happened that I've went and it was completely different than I thought. Like I'll show up and be like, all right, the parking lot's in a little bit worse shape than I thought, but not a deal breaker at all. And say, okay, we need another 50,000 on CapEx here. But the small numbers, which is kind of crazy. I mean, people like 50. Why are you talking about 50,000 like that? When we're buying apartment buildings, 5, 10, 15, 20 million bucks, a $50,000 parking lot, if that kills the deal, well, you were overpaying to start. Like it shouldn't be that tight. And especially if you sell it with a new parking lot, the new seller is going to pay you for that. So the new buyer is going to pay you for that. So that's my long-winded answer of saying I did not tour it before we placed the offer.
So how did due diligence go? Were there any surprises on due diligence?
So that was our first acquisition in Northwest Arkansas, and we're closing on an additional 2. And I can tell you all the properties that we're buying in Northwest Arkansas are coming with Excel type rent rolls and leases that are not perfect. So all the typical stuff that you go through on due diligence, we're buying these properties without it. So we have to go in, and a lot of times the way we buy properties is I'm not overly concerned. I'm concerned because of the debt. So I have to know what kind of debt we're going to get, but I'm not overly concerned of how it's performing today. I need to know how it's going to perform in 12 months from now. So as long as I'm able to put a number on what we're going to have it performing in 12 months from now, we're able to put together a very good pro forma based upon those numbers, and just based upon what it's doing today is going to really separate if we have to go bridge debt or we could just go, any other kind of debt, which we've actually been borrowing from Aetna, the insurance company recently, which is, it winds up being a little bit better than, a Fannie type loan for an acquisition that needs a little bit of work, but yeah.
All right. So just to kind of sound it back, you've got a 90s vintage property, some construction that needs to happen. You've got, a seller that's still operating off of, rent rolls punched into Excel, maybe.
Yeah.
So I guess when you toured the property, was it as expected? And, both like physically and financially?
Yeah, so something we have to look out for, and this is just like a CapEx item, when you're buying an apartment building that has, and a lot of them have it, it's the only reason I'm mentioning it, when you're buying an apartment building that has exterior stairs for the second level apartments, so a lot of them are built like that because when they're building the apartments, the wood stairs are very economical and they could get people to the second floor. So those wood decks are extremely expensive, and they're extremely expensive to replace, and they're expensive to repair, and they're expensive to upkeep. And I see a lot of operators go bad with just that one line item. So basically, when we went there, it was exactly how I expected. I know that's not good for a story, but when we went there, I was like, okay, the wood decks, they're in the 90s. They were built in the they were built in the mid 90s. Actually, I'm giving you bad information. That property was built in 01. The property we're buying now is built in the 90s. So that was a 2000s product. So the decks were, the decks are 20 years old. They're going to need some replacing, and they're going to be totally refinished. So, and some places in the South, the other thing is they build their parking lots out of concrete instead of asphalt. So the concrete lasts longer, but when it's time to replace it, it's significantly more expensive. So we went there and we were happily surprised that the parking lot is actually in great shape. So the biggest thing that we did when we bought that property is we went in, it needed a really, really, really good power wash. And I went back to the property after we purchased it, just talking to some tenants and saying, hey, what are you guys thinking? How you liking the changes around here? They're like, I'll tell you one, that power wash made a huge difference. So, on the other side of all this CapEx, you could say, sometimes you just need a little bit of a power wash. Because another mistake I've made in apartments is over improving. So, you go in with these monster plans and then you step back and look at that plan and be like, I don't know, that whole plan isn't really that necessary.
Mm-hmm. No, I do own property in Northwest Arkansas myself, and yeah, sometimes in that market, you just need a good power wash for sure.
Yeah, yeah. Well, just know what you're renting. We don't have to make. We have to provide. My thing is always good, nice, clean apartments. So, are you going to get paid for new marble countertops, or are you going to make the money that you need? Are you going to be able to charge the money you need to charge by just doing good Formica countertops or laminate countertops? And it could very well be that the marble countertop or the stone countertop will cost you, an extra $1,500, $2,000, and it literally doesn't do anything to the rent because your tenant base just doesn't care. They're looking for nice, neat, clean, quiet place to live. That's it.
Yeah. Well, let's dive into the financing. You mentioned that you borrowed from Aetna on this deal. So, tell us how, the rate structure was, loan to value, recourse, non-recourse. What were all the details of the lending on this property?
So we do non-recourse debt. It's with Aetna. This is the third time we're borrowing from them. We borrow 65% leverage. And we did that just because of the market, the uncertainty of the market. What's the absolute safest real estate to buy? It's the one without debt on it. So if you buy a property cash, you almost eliminate all the risk, as long as you're not, you don't vacate the whole property. So we lowered the leverage. Typically we'll go to 70 if we could, but so we borrowed 65%. The rate was 6.02%. So basically 6%. It was a 5-year fixed loan and 5-year term. And at the end of 2 years, we could prepay it at any time. So we're able to pay the loan off at year 2. And they also gave us a line of credit for CapEx items for $200,000 that if we don't use it, we don't pay on it. It just sits there, and when we need it, if we needed it, we grab it, and we'll just pay that same interest rate on that money after we draw it.
Awesome. Well, you also raised money on this deal. So how much did you finance? 65% of just short of $5 million. How much did you raise for this deal, and what was the structure of that raise?
Yeah, I think we raised about $2.5 million. $2.5 million, 70-30 split, 6% pref. We don't go too hard on the pref. We like to give a good enough of a pref just to make sure that the investors accrue some, and then we do the split after that. And the reason we do that is we never wanted to set too high of a pref where we always indebt ourselves to the investor. Because if the deal doesn't work, then if there's anything wrong with the deal at all, as far as owing people money, well, then it will overall hurt the deal. So I have seen people put monster prefs on deals, like to attract investors. And I'm like, man, that's not that good of an idea, because now you're indebted to your investors. And if you get so indebted into your investors where you can't pay them, well, then no one gets paid. So let's protect the deal. And I always tell people our number one concern at all times is the deal. We have to make sure that the deal is protected. So we raised $2.5 million. It's going to be a 2x equity multiple in 6 years. We're actually outperforming our underwriting currently. So we'll see what happens going into the future. You never know what could change. But so 2x, we target a 2x equity multiple in 6 years. That's our fund target. That's what we target internally. And we try to refi at least 50% of the money out by year 2. So if rates went up another 50 basis points, this deal specifically, we'd be refining about 60% of the investor's original capital by year 2. If rates decide to go even higher than that, then that refi will just be a little bit lower. But if we wanted to stay in the loan, we could just stay there for 5 years. If for some reason, things went very badly, and then we have a good enough period of time, we believe, to hold on and go along for the ride. So that's basically how the raise looked.
And what kind of fees did you charge the deal? Like acquisition, asset management, disposition?
So we do 1% disposition, 1% refinance fee, a 0.5% finance fee on the way in, and a 2.5% acquisition fee. So we do a 2.5 or 3% acquisition fee on deals under 10 million. Once deals pass over 10 million, we drop our acquisition fee. The acquisition fee, percentage-wise, it kind of has to be there in order for us to do these smaller deals. And the smaller deals wind up making very good sense for the investors, and it does keep opportunity open, especially in like a market where the larger deals are frozen and there's nothing going on. There is good movement in those smaller deals because, people have owned them for a long time. So if they've owned them for a long time, they may not be as up as they could have been if they sold it 2 years ago, but they're still very up from when they purchased it. So that's our fee structure. What else do we charge? Oh, asset management fee, 3% asset management fee. So 3% asset management fee against total receivables. And that's the fees.
So kind of going back to the refinance part of the deal, I had a kind of a follow-up question there. Your plan is to refinance out after a couple of years after it sounds like you've gotten your value add plan complete. Crystal ball question for you. Where do you see interest rates going, and how would you advise a newer operator getting into the market? Do you advise them taking on that type of strategy, like a value add strategy, and making the deal where the deal has to work on, predicated on a refinance?
So our deals don't have to work on a refinance. We tell all our investors, they say, where's the risk? Like, well, the risk is interest rates shoot up through the roof when we don't refi. And then we'll just keep collecting our checks. And cash flow will arguably be the absolute best in that position because we have the lowest debt on it. Because when we refi, we're going to raise the loan, the loan balance is going to increase. So we're going to have strong cash flow at that period. So if we don't have to refi, if we can't refi, we don't have to, we'll just let it ride. So what's my opinion of the future of the rate market is don't bet on them going down. We're not betting on rates going down. So there's a lot of arrows pointing in the direction that they will, but I'm not taking that bet because I don't think it's unreasonable to borrow money at 6% range. I don't think that's expensive money. People are calling it expensive money today. I don't think it is. I think it's just what we got used to over the last too long that people are just, spoiled. And I don't think rates are going to come down anytime within the next couple of years. There's no reason for them to. Sure, home prices, because really, who's going to move first is the question. So a rate's going to come down so people can afford them, or sellers are just going to have to take less. Someone's going to move first. And I think the Fed isn't overly concerned about, there's definitely people who say, listen, prices just shot up. People just captured a whole bunch of equity on their house. Is it that big of a deal if now they capture less equity? It's not. I don't think the Fed really worries about people losing equity on their homes to make housing more affordable, as opposed to lowering rate. Because if they lower rates, house prices are just going to climb again. And then at what point is it completely out of control? And I think we might be there. I think home prices are just going to have to come down. People are going to get. Just the interesting thing is so many people are locked into low interest rate loans. That's the most interesting thing about this whole topic. Is there's so many people who could just say, you know what, I'm going to do nothing. Like, well, then how house is going to go on the market? If people say, well, I'm not going to do anything because my payment is half of what it would be if I moved, and we really don't have to move, so let's just do nothing and renovate. So, that's the interesting part, is the majority of the country is not going to be forced into selling. And that's like the big kicker of like, okay, so if we don't lower interest rates, people who currently own homes aren't going to sell them. If we lower interest rates, all home prices are going to go up, but the payments will come down. So it's a very interesting topic, but internally we're not betting on interest rates coming down.
Well, I want to wrap up with a couple questions for you.
Sure.
On this particular Willow Park Apartments, what did you find easy during the process that you thought was going to be harder? And then what actually ended up being harder that you thought was going to be easier?
So what wound up being easier than I thought? How about this? Lease renewals are coming in significantly easier than I thought. So we spec'd out and underwrote that a whole bunch of people were going to leave because we were going from average rents of like $600 and $700 to $1,100. So we thought we were going to see a big vacancy, and almost no one's leaving. The people that are leaving, we probably have less than 10% leave. So if we renew 10 leases, one person's leaving. So that's definitely easier. And what was harder than I thought it would be? That was a very smooth sailing deal, I have to say. There's nothing that really shocked us or put us out of our way. It was just one of those deals like, hey, lock it up, close fast, move as quickly as you can. It's good. An interesting thing is there's a dump right next to it. So this is a wonderful area, and right next to it is a multifamily that a doctor owns that's completely run down. And as soon as that goes, which is for sale now, as soon as that goes, where our corridor is going to be significantly nicer, because that's the sore thumb, is the one next to it. And we offered that doctor money to purchase his at the same time and make it one apartment community. And at that, we said the deal's off the table once we close. And we're being serious. We're not just being salespeople. If we close on this one deal, we will not buy your deal. So sure enough, after we closed, he said, hey, you ready to buy it? We're like, no, we're not interested. So he's like, oh, come on, give us an offer. We're like, all right, we'll give you an offer, but we're not interested in buying it. So he didn't take the offer, and it's been sitting for a while, and I think he's going to have trouble selling it. We were the perfect buyer because we were willing to pay more than it was worth at the time, because now we're turning our 56 unit into almost a 100 unit. So now we have a 100 unit deal in Fayetteville, Arkansas, which very difficult to come by. So
why wouldn't you do that now?
Because when the fund was open, we had an economy of scale. So, closings happening at the same time and the deal being in the same fund made it so we could pay a little bit more, because now we're packaging it with another deal. Now, if we have to buy it, that fund is closed. Sure, we could reopen it, but now the amount of legal and expenses that are going to go into buying this smaller apartment community, we won't be able to pay what we were going to be able to pay closing it with the other deal. And it's truly behind an economies of scale thing. just through the, even closing costs. I mean, closing costs, everyone knows closing costs are extremely expensive. To run it through that now and still try to get the same return and have to repair it because it's in fairly bad shape. And we're already past that point on ours, meaning like that initial kind of kick up where we could have threw it into the pile and say, you know, for example, power wash that and this, you know, so now everyone logistically is coming out twice. It threw it off kilter, and now it's like, you know, you have to sell it. You're going to have to sell that to a smaller investor who wants to invest in something small in his local town. He'll come in, do his thing, and brush it up. But yeah, it's an economies of scale thing.
Makes total sense. Well, Chris, thanks so much for sharing your expertise with us here today. If people want to find out more about you and what you do, how can they do so?
So the website is stoutcap.com, STOUTCAP, stoutcap.com. And my Instagram is official Stout. So we try to put a bunch of content out on there. You'll see me at the properties, all that. So Instagram and the website, best ways to get to me. DM me on Instagram. I answer them all.
Awesome. Well, Chris, thank you again. We look forward to having you back and learning about your future deals.
Yes, thank you.